In 1969, Congress buried a single provision inside a 900-page tax bill, a rule that let America's wealthiest families give away a fortune and keep collecting income from it for the rest of their lives. And to this day, almost nobody outside a tax attorney's office has ever heard its real name, let alone what it was actually built to hide. By the end of this, you'll understand what they didn't want written in plain language. The bill was called the Tax Reform Act of 1969. Nixon signed it that December, after a public outcry when the Treasury revealed that over 150 Americans earning more than $200,000 a year, a fortune at the time, had paid zero federal income tax. Lawmakers promised a crackdown on the rich. Buried inside that same bill quietly was a tool that would let the rich pay even less. It was called the Charitable Remainder Trust. On paper, it looked simple. You place an asset in the trust. You collect income from it for years, sometimes for life. Whatever remains eventually goes to charity. Here's what made it different from any ordinary gift. If you owned stock that had grown enormously in value, stock you'd held for decades, selling it outright meant a massive capital gains tax bill. But move that same stock into a charitable remainder trust first, and the trust could sell it completely tax-free. No capital gains. None. The trust then invested the full untaxed amount and paid you a yearly income off the whole sum, not the shrunken after-tax version. You got to behave as if the tax had simply never existed. And the deduction didn't stop there. The moment you funded the trust, you also claimed an immediate charitable deduction on your income taxes, years before a single dollar ever reached a charity. The official explanation was generosity. Lawmakers said this was meant to reward Americans for giving to good causes, to make philanthropy easier. And for a while, that explanation held. But here's where it falls apart. The law only required that charity receive at least 10% of the trust's original value at the very end. 10%. The other 90 could legally flow to one family, structured over a term of 20, even 35 years, drawn down as income before the charity ever saw a cent. Now watch what happens next, because this is the part almost never gets said out loud. Estate planners figured out you could pair the trust with something called a wealth replacement trust, a life insurance policy purchased using a slice of the income the Charitable Remainder Trust was already paying out. The insurance payout when the donor died went straight to the children, tax-free, outside probate, untouched by estate tax. So the family effectively got three things at once. They avoided the capital gains tax on the original sale, they claimed a charitable deduction up front, and they replaced the money that was given away with a tax-free inheritance for their heirs, funded in effect by the tax savings itself. Internal Treasury reviews in later decades flagged this exact pattern, noting that in a meaningful share of large trusts, charities were receiving close to the statutory floor and nothing more, while families extracted decades of income and a clean intergenerational transfer. Almost none of it made headlines. It didn't need to. It was legal. It still is. Remember that provision buried in a 900-page bill meant to punish the ultra-wealthy for paying no tax. This is what it actually built. Estimates today put the assets sitting inside charitable remainder trusts in the hundreds of billions of dollars, money technically earmarked for charity that, in many cases, won't arrive there for another generation if the structure isn't renewed or restructured before then. The attorneys who build these trusts don't call them a loophole. They call it the most powerful tool in estate planning, and they say it in seminar rooms, not headlines. Every few years, a member of Congress proposes closing the 10% floor, tightening the term limits, forcing more of the money toward charity sooner. Every time, the proposal quietly dies in committee. The same families who benefit fund the campaigns of the people who'd have to vote against them. So ask yourself this. A law written to punish the rich for paying nothing became, within the very same bill, a way for the rich to pay less than ever and hand it to their children clean. Was that an accident of drafting in 1969? Or was somebody in that room writing the exception before they ever wrote the rule?